Alright, ladies and gentlemen, welcome to today's video. Today's going to be a very short one, but it's going to be a very, very important one about risk management and the whole maths behind pocket option that they don't want you to know, and is the math that I have discovered over time. So I'm sure many of you know the traditional risk model called martingale, where you increase or double your bet every time you trade. Of course, this works where if you win on this, you'll have profit, you'll have profit, you'll have profit. Here you'll have somewhat of a profit, but the profit starts to diminish. The more and more you double, the less and less your profit becomes. You'll see this will be 0.92, this will decrease and decrease until it hits this point where it actually starts going into negative. So your profit, as your total number of trades increases, right? This is your total number of trades and this is your profit. It actually has a downward sloping effect like this, and it will actually go into negative. So you'll see if you actually won on a $16 trade, right, you'd get 92% payouts because of pocket option and how they work with 92%. If you subtract all the previous ones that you doubled, which would be 8, 4, 2, and 1, you would go into a negative, and you'd see it's even more for 32. So if we go to 32, we will see that the loss will be even bigger. So we have to minus 16, minus 8, minus 4, minus 2, and minus 1. Now you'll see that the loss gets bigger and bigger and bigger because we're going to slowly fall even more and more into the negative profits or the loss, which we don't want. However, over time, I discovered and found a risk model that works really well. So if you are doing 5-second trades on a 5-second time frame, the ideal goal is to be trading the entirety of the candle, right? So we would enter at the start of the candle and then the trade would automatically close at the end of the candle. I found that there's 3 models that you need to work with. You either aim for +1 units, right? So let's do that a bit better. You either aim for +1 units, you aim for break even, or you accept -3. This will be your take profit, right? Your +1 will be your take profit. 0 or break even will be there in case you do go down into drawdown, but -3 is where you have to accept that loss and move on. So in a strategy, what you'll find is that if you accept +1 units off of your first trade, this normally happens around 60% of the time, right? Most strategies do around 60%. But how can we leverage this and make it safer so that we don't have to experience all of these losses? Well, we also have the break-even model, and the break-even model will happen if we go down into -1 or -2 units. And then finally, we are given 2 choices. If we go down into -1 or -2, we trade that until we hit break even, or there is a possibility that we could go into -3 and we would exit. So whenever we exit either 3 of these or we hit either 3 of these, we have to get out. But I want to show you the math behind this so you can see the power of it. So because this is 60%, that means that the probability of hitting a 0 or -3 is 40%. But now what you'll find is that because you go into drawdown, you go into -1 here, the probability, because of the power of hitting a +1, is 60%. That means there's actually a 60% chance that you would still hit break even, right? There would be another 60% chance here that you would hit break even, which means that there's another 40% chance that you'd go into -2, but then that probability keeps working back and forth, which means that the probability balances out to around 30%. There's a 30% chance that you'll break even, leaving a 10% chance of hitting -3. So I put this into equation to show you guys visually how it would look. So this is all the probability here. I put all the values in. You'll see I explained it all there. And it comes out to an expected value of 0,252 units per sequence, which means 0,0252, I believe, 0,252 per sequence means that for every dollar or for every single $1 trade you take, you actually make $0,252, which means that in the long run, you will continue to make money. It's almost like a graph like this, and this reflects your gradient, right? Your profits and your total trades, this will be the gradient, and over the long run, even though you have drawdown, you will make money. And that is the smart risk management that you guys need to follow to make money off pocket option.